Welcome to Money Curiosity. In this video, I'll explain what private markets are, how they work, who can invest in private investments, and the risks and rewards. Let's get started. A private market is an investment in an asset that isn't traded publicly. To be traded publicly is to have a public exchange, transparent and accessible to the general public. They provide investment opportunities outside public stock and bond exchanges. Private markets include private equity, private real estate, venture capital, etc. Private markets work like this. Investors raise capital through a private placement. This is simply stock being exchanged between institutions and investors without an open market, allowing companies to raise capital quickly without an IPO. The raised capital is usually managed by investment firms that invested into private assets like private equity and VC. The returns are usually realized after several years, from acquisitions, appreciation of real estate, or other sources. These investments constitute higher rewards and higher risks. On the reward side, private markets have more potential for higher rewards, particularly in early-stage ventures and successful buyouts. The top 25% of private equity funds have historically outperformed public markets. Of course, past performance of private investments is not a guarantee of future results. Many funds underperform or fail. Overall portfolio volatility can be reduced since returns have less correlation with public market dilemmas, providing diversification. Private market investments give access to disruptive technologies and emerging industries before they are widely available to the public, allowing for potential high returns. On the risk side, private markets are illiquid, have complicated structures, blind pools, valuation uncertainty, and high fees, often including a 2% management fee and 20% of profits. Private markets are much riskier than public ones. Real estate loans and private equity stakes, for example, have multi-year holding periods. Your money could be inaccessible for 7 to 10 years, so be sure you can afford to keep that money untouched. Private assets don't have a clear daily market value like stocks do, so it's harder to track performance. They often require significant upfront capital to invest in, like minimums between $25,000 and $100,000 for some real estate funds. Often, though, minimum investments start at $250,000 or more. They also aren't as heavily regulated as publicly traded assets, so they lack standardized disclosure. This means fewer reporting requirements, fewer investor protections, and fewer frequent disclosures. Do your own due diligence, and stay up to date with regulations that may affect your investment. To elaborate further about the upfront capital requirements, let's go over who can invest in private market investments. Many funds require you to be an accredited investor, meaning you need to have at least $200,000 annual income or $300,000 jointly, or over $1 million net worth excluding primary residence. Some funds are open only to qualified purchases, those with $5 million or more in investable assets. We discussed the minimum investment requirements a few moments back. These rules exist because they are meant to protect less experienced investors from the complexity and risk of private deals. In summary, private market investing offers great opportunities for high returns, but it isn't for everyone. When done well, private investments can help diversify and complement a broader financial strategy. When misunderstood, they can bring frustration and regret. Greater opportunity brings greater responsibility. This content is for informational purposes only. I'm not a financial advisor, and you shouldn't base investment decisions solely on a YouTube video anyway. If considering private investing, I recommend speaking to your advisor first and fully understanding what it is you're getting into before putting money down. I hope this was a useful video. Thanks for watching, and have a great day.